My name is Joseph Beige. I'm a real estate attorney on Long Island, and I want to welcome you to today's webcast. For our returning viewers, I always want to start out by thanking you for watching, and I appreciate the comments and all your support. If this is your first time watching our webcast, let me tell you what we do. With the help of a guest, we'll be discussing a topic that's related to real estate, and the goal is to help make you, the Long Island real estate consumer, allow you to make a better, more informed decision in your next transaction. Now, today's subject is going to be very interesting, or at least I find it very interesting, because we're going to be discussing one of the most misunderstood and misaligned home financing options available. And that's we're going to be talking about reverse mortgages. Reverse mortgages are very unique, and they allow seniors, retirees, people on a fixed income to stay in their home, drawing on the equity. But there's so many myths about them, and even people who are inside the legal profession who you would think would know better don't understand them, and they constantly put these down. To help us understand reverse mortgages, I'm joined today by Ralph Taylor of UNMB Mortgage Bankers. Good morning, Ralph.
Good morning, Joe.
Thank you for joining us today.
My pleasure.
Hopefully this won't be too painful for you.
Hopefully I can help.
Now, again, we're talking about reverse mortgages today. And as I said, they are one of the most misunderstood, if not the most misunderstood types of financing on a home. Just so we all know what we're talking about, what exactly is a reverse mortgage?
A reverse mortgage is set up to help seniors 62 years and older live in their homes forever, basically. It's a way of them tapping into the equity in the property and not having any additional monthly debt.
There are qualifications for a reverse mortgage, as there are for any mortgage. But what are some of the qualifications?
Qualifications aren't that hard. It's basically you have to own a home, you have to have equity in the property, and you have to be 62 years or older in order to go for one.
And now there is still an underwriting process very similar to any other type of loan, correct?
Yeah, it's mine. And they do run your credit to make sure that you have somewhat fair credit. They make sure you have enough income coming in to cover your taxes and insurance, because you're still liable for that. You know, even though you have a reverse mortgage, you pay your own taxes and insurance. And they make sure that the house is in decent shape. It has to be in fairly good shape.
Now, if the house requires any repairs, are those allowed to be factored into the reverse mortgage?
Yes, they can do what's called a repair set aside, which they take part of whatever money you're getting out of the reverse mortgage. You have a contract to come in and fix it, and then that's paid out.
Now, we hit on when I first asked you about what a reverse mortgage is, that it's a way of drawing on the equity on the house.
Right.
Now let's talk about a little bit about that. When we talk about drawing on the equity, there are limits. I mean, you're not able to draw out 100% of your equity, correct?
No. Reverse mortgages are basically based on an actuarial computer program. And what they do is they put your age in there and they put the value of the property. The computer will spit out exactly what they call it your entitlement, which I kind of take that as a funny statement, but it's your principal limit. The average principal limit is somewhere around the 55, 60%. It's based on your age. So the older you are, the more money you're entitled to.
You talk about it, that it's basically 50 to 60% of the equity in the house.
Right.
We're going to touch back on that later, because I've even had attorneys at a seminar, ironically, on reverse mortgages. I had an attorney mutter under his breath that a reverse mortgage is a great way to leave or to lose your inheritance for your relatives. And I'm sitting there saying that's exactly the opposite. And, that's a big part. If you're only taking out 50 or 60% of the equity, there will be a substantial amount left for your estate.
Depending on what the market does, they are designed to not have no equity left in the property, depending on how long people live. Like I said, they're based on an actuarial table, so the older you are, the more money you get. But they look at how far your house is going to appreciate over the years. So they take an effect. If you're getting 50% and you're 76 years old, the average lifespan for a woman in this country is probably 84 years of age. And they're based on a lifespan of something I hear, and I'm told somewhere around 125 years of age. So as long as houses aren't dropping in equity very fastly, you very rarely outlive the equity in the property.
Now let's talk a little bit more about exactly the mechanics of how a reverse mortgage actually works. Because then you said you're drawing on the equity. Right. All right. Now, there are a couple of different options for when somebody does it, right? I mean, they can take out and they can use it almost like a home equity line of credit, draw when they need. They can draw it all out at one point. There are payment options about they can or cannot make.
On a reverse mortgage, there's several ways of getting paid. You can get a monthly stipend, you can get an equity credit line, or you can get a lump sum, or you can get a combination of them. So again, it's based on your age, and that's set up through the program of how you want it. And you can change that prior to closing, because a lot of people aren't sure what they want. I get a lot of clients that'll say, I'd like to have a little nest egg. So can I get $20,000 and then the rest as a monthly income for the remainder of my life? You do have to pay off your current mortgage with it. And some people find they're not getting enough out of their reverse mortgage. Like that person I was just explaining, like $300,000 value to a property, and you have a $130,000 mortgage. I'm going to pay off your mortgage. You'll have closing costs, and you might have some money left over. And they go, well, what's worth it to me? And I go, you're having trouble making your mortgage payment now. You won't have that any longer. You don't get 100% of the equity in the property. That's left because interest accrues over the life of the loan. So that's basically how that works.
Okay, interesting. And 2 points. So one is that you just said the interest accrues over the life of the loan when you're not paying it back. And we'll get back to that part. But you also mentioned about having to pay off the primary.
Yes. Now,
that's an important distinction, because a reverse mortgage is in what we call the first position on the bank, on the lender. So again, it's great for people who have no mortgage or very small mortgage.
Yes.
But if you have a high mortgage, if you bought your house recently and you only have 20 or 30% equity, again, you may not be able to cash out, so to speak, but you can free up cash on your monthly income.
If you have enough equity, if you only put 30% down and you just bought it, you might not be able to. I've also had clients that actually didn't have enough in the reverse mortgage to pay off their current mortgage, but took it out of savings to do it because it saved them so much money on a monthly basis.
Absolutely. If your mortgage is costing you $2,000 a month and you have to lay out an extra $10,000, you're already breaking even within the first year.
Right. It's a no-brainer. It depends how you look at it.
Okay. And as always, and when you sit down with any kind of a situation like this, when you're talking about financing, you really want to find the right person to give you the right advice.
100%. This loan is probably the most governed loan I've ever worked with over 35 years in the industry. It's pretty much on an even plate. So a lot of things that happen in this loan that I can go over quickly with you is like the equity credit line. You don't get it. You don't get a checkbook to write checks out, because their big fear is that, kid next door who for 20 years says, I need help with college. Can I borrow $500? And he helps you write out the check for $5,000. So what happens is you have to send either a fax or you call in and they wire the money into your account with the avoided check you bring to the closing to safeguard seniors.
And again, that's going towards the government, which was actually going to be my next question on who has the oversight on these. But there are checks and balances, realizing that the market, people who are generally going for reverse mortgages, might be susceptible to outside influence, and can be taken advantage of.
Well, a lot of safeguards there. I can talk to a senior about a reverse mortgage, go over all the qualifications, go over what their entitlement is or their principal limit, but I am not allowed to do anything until they have been counseled by a federal counselor. And I must give them a list of at least 10 counselors that they can call, pick one of their own, and then do a counseling course. They can either do it by phone or by person, and then they get a certificate. They get one, and they send one to me.
That's interesting. And as far as I know, that's the only type of loan that requires that.
It is. It's the only type of loan.
Okay. And again, like I said, as I kind of showed my cards there, but the next question I want to bring up is oversight. Mortgages, the whole lending industry does have government oversight. And as you alluded to, reverse mortgages have more oversight and more restrictions to protect the consumer than any other type. You hit on a few of them, but, such as having to go through counseling, restrictions on, again, they're not just given a checkbook like in a normal home equity line of credit situation. Who actually watches over the reverse mortgage industry?
The oversight's done by FHA HUD. They govern everything, and the computer programs we use are all pretty much identical. So this way, one bank can't scheme something compared to anybody else. And they actually, when I've had seniors, when they go for counseling, say, they're actually asked, are you being forced into this? Is anybody persuading you? Is it a family member? Is the bank? Just like myself as a banker, I cannot sell any other product to them. I can't be a financial planner and try to do anything like that. So, and that's forbidden.
Now, and again, that's something that I think the public doesn't realize, and when it comes to reverse mortgages, is that it's not a scheme to get your money. All right, I'm kind of stealing that from some certain mustached actor who's selling reverse mortgages on TV, but it really isn't a scheme, and the protections that are there for the consumer are pretty extreme compared to other types of loans.
Yeah, again, the most regulated mortgage I've ever done over my lifetime.
And you've been doing this for a long time, as we discussed.
Yes.
When it comes to reverse mortgages, again, the misconceptions and the myths are phenomenal. Okay.
Yes.
What are some of the biggest myths or the questions when people say to you, or the misconceptions that they come in when they sit down to talk about a reverse mortgage with you, and you have to sit there and say, no, that's not how it is?
Probably the biggest myth is people say, I'm selling my house. I'm not selling my house for that $150,000 or whatever the number is. I say, no, you're not selling the house. The deed is always in the person's name, or trust. You can do trusts on these. A lot of people don't realize it. Revocable or irrevocable trust, if they've been set up correctly. Some people think they should get more money than they're getting. But again, it's to safeguard them and all their family members, because a lot of people also think that their family members are going to be liable if the house is not worth what's owed. Because based on that actuarial table, somebody doesn't live the 86 years, they live to 94, 95, 96, and houses go down in value. You could actually owe more. But they can't hold anybody liable, not even your estate. They have what's called an MIP insurance, which is a mortgage insurance premium, to make it what's considered a non-recourse mortgage, meaning the house pays you back, nothing else. You could have $1 million in your bank account, they can't touch it.
And again, that is always the biggest thing that you see. And again, you see it on the commercials that everybody's familiar with. The bank is not looking to end up with the house. In fact, the bank should, unless the values go down, in which case the bank loses. All right. But if there is, again, you start out with equity. And the heirs have options when the person passes away. It's not like the bank comes in and says in a week the house is ours, correct?
No, the standard is once the owner occupant, and that's something we really didn't get into, but you must be your primary residence. You can't do it on a secondary home. So it's your primary residence. If it's a couple and dad dies, but mom's still alive, she can stay in the house forever also. Nothing changes. It doesn't change her Social Security, Medicaid or Medicare.
So now when the person passes away, again, as I said, the bank doesn't swoop in.
No.
The heirs have options.
Right. The bank actually gives you 6 months to decide what you want to do with the property, whether you're going to sell it or the family can refinance it. If you can't sell it or refinance it within that time frame, they give you an additional 6 months. What they really don't want to end up, and it sounds funny, is a weekend at Bernie's where people are just living in the house and just letting it deteriorate and not doing anything with it.
Because again, when the way the reverse mortgage is set up, that's the bank's gamble, was that there would be enough in the house, the value would be such that they would get paid off. Not that they would have to take back a house, have to market and have to sell it.
No, banks really don't want to take it back, because what you'll read in the newspapers is bank takes seniors home, and that's not real good press for the government or banks.
And in my experience representing clients who've had reverse mortgages is that the lenders have been very easy to work with. If the house doesn't sell fast enough, as long as you can show it's being marketed, you've hired a broker, as long as you're making steps, they're happy.
Right. They just don't like stagnation.
Yeah, which makes sense.
Total.
Yeah, okay. When a person does a reverse mortgage, they still own the house.
Yes.
Or the trust owns the house.
Right.
The house is not locked in. If they decide to sell the house at some point and move out of state,
no problem.
There's no issues with that.
None at all. You can sell it at any time you like.
Okay. And as far as, and you did hit on this about if they have a spouse or a companion who's living with them who's not on the mortgage, that person would be able to stay if the mortgage holder passes away. Right.
There's another caveat to that. And that is, say you have a man or a woman 80 years old, but they're married to a 61-year-old. It's based on their lifespan. So what a lot of people don't realize, it's not based on the older person. It's based on the youngest person in the family that lives there as a spouse.
Okay, interesting. So if we go back to some of the guidelines we talked about earlier with the actuary table, if you have somebody who's, let's say, the person who's going to hold the loan in their name because they have the income, if they're in their 80s, the other person is in their 60s. When they factor in how much of the loan can be given based on the equity, they're going to use the younger person's age.
That's true.
Okay, and now that can be actually an advantage.
Well, you get less money, but that person can stay in the house forever.
Forever.
Which is important.
This gets into a little bit more with estate planning. Okay. So if I'm going to be hitting you with an area that I realize is not yours, so don't be afraid to say,
I won't be.
But when we talk about Medicaid, and Medicaid certainly has a look-back period. That's why people use trust and they use living estates, life estates on their deeds. When somebody has access to this cash, Does that affect their Medicaid eligibility?
From what I'm told, no, because it's not income. I can't see what the difference would be if they went to the bank and took a home equity credit line on a house they own now anyway.
Got you.
But I'm not an attorney.
I was just going to say, I mean, I'm asking you the question, but the caveat is definitely there.
Right.
Your Medicaid is an entirely different animal. And as always, find an attorney who's qualified in Medicaid specifically if that's a concern of yours for qualification.
Also an accountant.
Yeah. If we have somebody who's interested in a reverse mortgage,
right.
Okay, they say, I'm over 65, I'm in my 70s, house needs a certain amount of work. Okay, I've got to put a roof on. I'm on a fixed income, 15 grand for a roof's a lot of money. And they decide they want to get a reverse mortgage. What are some of the tips and tricks that they should be thinking about?
On something like that, depends on how bad the roof is. If the appraiser notes it, then they're going to have to do what's called a set aside for it. If he doesn't notice it, you just take the money out at closing or put it in and you do it as a home equity credit line.
Okay.
Just to go to the home equity credit lines, you're not, like I was explaining before, you don't get a checkbook and no interest accrues on the entire credit line. It only accrues on the amount of money that you're using, which is very important because a lot of people think that you're going to, if I have a $200,000 credit line, I got to pay that, I'm paying interest on it. You don't, because you don't have it. It's in a virtual account and you're calling in for it.
So that person who draws out 15 grand for a new roof is paying on the 15 grand. That's what's going to be accruing, right. Not the other 150 or 175 that they have sitting
right.
there.
And with the equity credit lines, what's really good is they appreciate. On the unused portion, the way the federal government set up the program, it appreciates based on whatever the economy's doing. So I've seen them appreciate it 3%, 4%, almost 5% a year on the unused portion. And it's not interest, so you're not taxed on it. They just call it credit line growth.
So let's run through that again, because I think you hit me with something that I'm not familiar with. So if I have $200,000 sitting on my credit line unused, each year that's going to
increase on whatever that number is that they put in the computer system.
That's interesting. So in other words, if my house is appreciating, let's say 10% a year, right. And the government is appreciating my credit line 3%, we're kind of staying in line with my original loan ratios. That's pretty interesting. That's something I didn't know about a reverse mortgage.
Yep.
That's why I bring in guests like this, because
well, I don't know everything, but I know a lot. But it changes constantly.
Well, you certainly know more than me, which is not necessarily hard to do.
Okay.
Now we've talked about all the advantages and all the things that somebody who's interested in a reverse mortgage or thinks they are, what they should be doing, the questions that they should be asking of their loan officer. What are some of the pitfalls? What are some of the things that they should be watching out for? Now, one of them we certainly hit on was the undue influence. A relative or somebody trying to push them into, drawing out the money for their benefit, not the homeowners. But in terms of
a lot of pitfalls that I see, and there aren't many. One is if you look at, depending on how you look at it, the interest accruing. It's growing on what you owe. But then I point out to people, if you had a mortgage, you'd be paying that much a month. You also have the option to pay the interest on the mortgage if you like. A lot of accountants say it really doesn't make financial sense because if you have that extra money, put it into something that you can invest in. I don't see many pitfalls at all. For people that need it, it comes down to why you want it. And if you don't mind me explaining a few things, in one of your notes that you sent to me, you said, what's my normal reverse mortgage client? There is none. When I first got into it, I thought it would be people that were just desperate to have money. And I've been taught so much by seniors. I do some seminars on this, but one senior got me. He was like 82 years old. He went for it, and he didn't have a mortgage on his property. He really didn't need the money. I go, why are you doing it? And he said, Ralph, I have 2 kids. I'm 82 years old. They keep asking me, when am I selling the house? When are you getting rid of the house? And he goes, it's not like I have a bullseye on my back. He goes, but I know where I can find the bathroom at night. I know how to get to the golf course. And I want to give my kids part of their inheritance now before I die so I can see them enjoy it. I've had some people that need it because they can't afford food. But they're house rich and cash poor. And I had one client that really amazed me. They told me their bucket list was they wanted to get a Winnebago and drive around the country. So they took money out of their credit line and they bought a Winnebago and went across country. And,
one of the reasons why I wanted to have you on today and to bring it up is with the values of homes on Long Island being at historic, if not nosebleed rates, I think it's very appropriate now for people to consider reverse mortgages because, again, with the equity being as high as we've ever seen, it gives them options that they may not have had 10 years ago, and they may not have in the future because nobody ever knows what real estate's going to do.
That's true. And plus, as high as the taxes are on Long Island, a lot of people need just to keep the taxes. Also, if you have a reverse mortgage now with properties going up in value, you can do a reverse refinance, which a lot of people don't realize. And you can also do a reverse purchase. So if you're selling a house and want to downsize, and your house now is worth $600,000, and you have no mortgage on it, you end up getting $600,000, pay off your things, and you're buying something for $4,000, you can buy it all cash, or you can do a reverse mortgage on it where they tell you how much you have to put down in order to purchase the new property.
That's interesting. So you can actually use a reverse mortgage for a purchase of a new home under certain circumstances.
Yes.
That's another option that I didn't even know existed.
A lot of people don't.
That's great. That's great. Okay. Ralph, I want to double back because we kind of jumped right into the topic because, as you could see, I'm kind of excited about this one because I think the timing is right. And I think, again, this is one where when I speak to my clients on the estate planning, they really have so many unfortunate misconceptions about what a reverse mortgage can do for them. But I skipped completely over your background. Oh. How did you get into the mortgage?
It's kind of a quick story, but funny. In 1985, I was in another industry, and my partner's husband was in the reverse mortgage business, and he kind of challenged me to take a training course with him. I was kind of tired of what I was doing for the first 30 years of my life, basically, or 25 years of my life. So I took his training course, and I kind of enjoyed it. And I started working part-time in 1985. In 1987, I thought it was a good change, and I changed over, and I worked for a small mortgage brokerage firm out of Hop New York. I outgrew that company in about 4 or 5 years. I was one of the top producers, but I couldn't. I'm a person that likes to learn, so I went to work for a larger mortgage banking firm called Mutual of North America. I was there about 5 or 6 years, and they were actually merged with UNMB, who I work for now, and I've been with them since 2000. I think it is, in 1999. I've been their branch manager of the Smithtown office.
Impressive, 20-something years.
30-something.
30-something.
Yeah.
Wow. I know. Yeah. Well, now you know why I became an attorney, not an accountant. I can't do math in my head. Tell us a little bit about UNMB.
UNMB started, like I said, about 42 years ago. It was started by a man named Tony Giorgio and his son. It was a small, second mortgage type lender. The father was a contractor, and people couldn't afford houses, and he got a broker's license and started doing that. His son went to college, and his major was business, and he came into the company when he was of age, and he's grown it tremendously over these years. His father's since passed away, but it's a family-owned firm, very family-oriented. He grew it from probably a $20 million company to last year we did $1.4 billion. We're licensed, I believe, in 22 states now, and he's a hands-on guy, and we have a lot of time taking classes and learning. And you're never too old to learn. I'm going to be 68 this year, and I'm in a 7-month training class right now on different things on sales and products. And it's enjoyable.
That's great. Great. Ralph, first off, I want to thank you so much for being here today and for the information you presented. I learned a lot. I mean, there's at least 2 or 3 different things that we hit on today that I absolutely did not know. I'm sure people who are watching, if you had any interest and knew anything about reverse mortgages, you probably found out you didn't know as much as you did. Ralph's contact information, as always, is going to be at the end of this video. Please feel free to reach out to him if you have any questions regarding reverse mortgages or anything in the financial area with your home. Again, reverse mortgages are one of the most misunderstood, misaligned types of home financing. And as you heard today, it is tremendously flexible. It can do a lot for people to allow seniors and retirees to stay in their home, especially on Long Island, where downsizing is not necessarily easy or cheaper. So you may want to certainly consider it. As always, especially if you're a senior and you're looking at Medicaid and issues of that nature, you're going to want to need an attorney, not just for the reverse mortgage, but you're also going to need an attorney to help you out with your Medicaid planning, because nothing happens in a vacuum, and one thing does tend to feed onto the other. As always, my name is Joseph Beige. I'm a Long Island real estate attorney, and I want to thank you for watching our webcast. Thanks.